So let me switch to a new book, another book. So how many people here are familiar with Michael Lewis's book, Liar's Poker, The Big Short, The Blind Side, all of that? So this is his latest book called The Undoing Project, and it's about two guys who had a bromance for the better part of 45 years. Daniel Kahneman, who was an introvert, Holocaust survivor. He's a psychologist. He taught at UBC for a few years in the 80s, and he won the Nobel Prize in Economics in 2002. His partner, Amos Tversky, was an Israeli extrovert, and he was also a psychologist. He taught at Stanford. He was the superstar. He was considered a superstar from a global perspective as a psychologist. But he died young before the Nobel Prize, so he never got it because it's not given posthumously. So their theories, they had a number of them, but the one that kind of really matters is this issue of loss avoidance. We're going to have a little test to just see how you guys do on this, but let me just sort of give you the theory. Essentially, it says you feel more pain when you lose something than when you win something in terms of joy. So here's the question. We got $100 on the right, we got $80 on the left. So you got a choice here. You can either get a guaranteed win for the $80, or you get an 85% chance of winning $100, but a 15% chance of losing it. So hands up all those who want the guaranteed win. All right, okay, everybody, right? Hands up those who are willing to take the chance of the 15% loss. Okay, well, you guys are smoked. Now, I will say this, you guys, the majority do pick the guaranteed win. But from an investment perspective, those who chose the 85% are the winners. And the reason they're the winners is very simply this. If I do this bet 100 times, on the right-hand side, my average winnings will be $85. They have to be, which is more than they can possibly be on the left-hand side. Why do we choose the left-hand side? We hate the idea we could lose, so we avoid it. Let me reverse the question for you. You got a 100% chance of losing $80, and you have an 85% chance of losing $100, or a 15% chance of winning $100. All right, let's try this again. How many of you are going to go for the guaranteed loss? You are pretty smart, aren't you? So the majority do pick this, and of course the issue is this: they choose this. Now, some of you said most of you don't want the guaranteed loss. You would take the 85% chance of losing and the 15% chance of winning. Again, I hate to tell you this, wrong. Why? Again, 100 bets on the right-hand side. What's my average loss? $85. What's my maximum loss on the left-hand side? $80. Therefore, I would choose the left side. The guaranteed loss is the better bet. Okay? Behavioral finance is about the way we make decisions about money. So let's look at a couple of other things. We wrote a newsletter years ago called 7 Habits of Highly Ineffective Investors. And I'm just going to give you a couple of them because I've done this before. But another habit that really is very bad for investors is over-optimism. Basically, we generally believe we're in the gifted program. And it's kind of like, where 80% think we're in the top 50%. And it doesn't really matter. I could ask this group any question. How are you as a driver? How smart are you? How good looking are you? It doesn't matter what the question is. The answer is going to be the same. 80% of you are going to think you're in the top 50%, which is probably great for your self-image, but it's not really good as an investment trade because it makes you over-optimistic about how the results are going to turn out. It's like being, the children of Lake Wobegon. And another one, which probably is my favorite one, is this one, and which we'll look at in a little bit more detail, which is gambling with house money. So while I don't go to casinos very often, and I'm sure most of you don't as well, I'm sure that you have from time to time gone. Most of the time, probably you've lost. But once in a blue moon, you can remember a time you went to a casino, and at least at the beginning, you won. So I want you to remember that time and think, okay, I've been there 3 hours, I'm up $1,000. I'm ahead. I can go crazy now because I'm gambling with the house money. At no point does it occur to you that money, that $1,000, is actually in your pocket as opposed to the house's pocket. In another 3 hours, it will be in their pocket, but for now, it's in your pocket. So what we do, we basically say we want to raise the minimum bet because we're ahead. So we increase our aggressiveness when we win first. So what does that mean when you're investing, say, in the stock market? You increase the risk when markets rise. You decrease the risk when markets drop. Let's examine, are there any times when you might have been, or I might have been guilty of that? Let's consider what was happening to stocks in the late 90s in the dot-com boom. And when the NASDAQ crashed 80%, did you say, let's buy a lot more of that stuff now that it's 80% cheaper? At the end of 2008, early 2009, could you just not wait to get in the stock market after markets were down 50 to 60%? Probably not. But of course, that's when you would have made the highest returns. So when Dalbar does a study of investor performance, this is what they look at. They look at investors' performance. In this case, they're looking at the stock market. This is the S&P 500. And then they're looking for the difference between the two. Keeping in mind, they're looking at tens of thousands of accounts over as long as a 30-year time frame. On average, regardless of the time frame you pick, investors' performance is 4 to 5% per year less than the actual market they're investing in. So recently, I was reading a Globe and Mail article, and it was one that was talking about buying what are called smart beta funds. Smart beta funds are exchange-traded funds, low-cost funds that try to provide some intelligence in the way that they select stocks. And whether you agree with that they work or not work, what Vanguard was doing in this case was doing a side study to say, okay, we know what we earn in these funds for our investors, but what do the investors make when they buy these funds? Now, in theory, the two numbers should basically be the same, but they're not. They're not even close to the same. When the Vanguard looked at its value fund as of 2017, the fund earned 5.8% net of fees. The average investor in the fund earned 1.8%. When they took a look at 3 other funds they had, they found that on average, there was a drop. There's no fund that they own where the investor earned even the same return as the fund, let alone a better return than the fund. So the question you have to ask yourself is, how does this happen and what's causing it? And most of it is because we can't bring ourselves, even if intellectually we're saying, of course we'll buy things when they're cheaper, right? But we don't, emotionally it doesn't work that way. So what you're looking at, because I had to go back 2 years, so about a quarter of our funds had a negative year in 2015 and 75% had a positive year. The losing funds, on average, lost 7.5%. The winning funds earned 11.4%. The weighted return in a balanced portfolio with us that year was 7.5%. What happens at the end of that year? What should happen is very simply this. You sell the green and you buy the red. What do most people do? Exactly the opposite. So the idea is you need to have a disciplined structure in the first place in order to avoid these things, because otherwise they're going to constantly keep happening. Those Vanguard investors are basically doing the opposite of exactly what they should be doing. So here's an example which I shared with you last year, which was one of our worst performing pools was the preferred share fund. And it's interesting because it's one of the safest pools that we have, but it got hammered for a couple of reasons I'll explain in a minute. But over basically a period of 15, 16, 17 months, the fund was down 35%. The yields, therefore, were up almost 50%. It was being triggered by a combination of interest rates being too low, so the bonds were renewing at low rates, and the fact that banks were issuing new preferreds because they had to raise capital, and they were competing with the existing preferreds in the marketplace. So basically, the market cratered, and what was a relatively safe asset, nobody was worried about whether the companies that issue these preferreds were not going to be able to pay them. It was the issue that the market didn't like the dividend rate on them and basically drove the market down significantly. And taxes, by the way, on preferred share income is about 20% less than it would be on interest income. They have a lot of advantages. So let's take a look at what happened. We thought that this would recover in about 5 years, and so therefore we wanted clients to be able to actually add more to it. So if you go to our website and look at the preferred share fund, you'll see that that recovery has happened, But even so, the total return over the last 6 or 7 years is about 5.3%, the kind of return you might expect to see on a reasonable bond fund or a mortgage fund. But that 35% recovery we hoped was going to take 5 years happened in 1 year. Did we have any idea it was going to happen in 12 months? No, no idea at all. But the market doesn't give you that kind of heads up. So the issue about rebalancing, and it's very important to appreciate this, you're not trying to market time. You're trying to use discipline to do the same thing consistently all the time. Sometimes you'll get very fortunate with it. Other times you'll take longer to get the result. But you'll get a better result regardless. So if we take a look at the impact of that, this is a particular client account who took advantage of the fact that the prices were low and bought over a period of time, so that their return on exactly the same fund is 7.9%, not 5.3%. Because again, they did what we've asked them to do, rebalance when some asset class has taken a hit. So you sort of have to be the Vulcan investor. And you know, if any of you are big Star Trek fans, and I'm a Star Trek fan, just want you to know, it's not just because of how old I am. The bottom line is there is only one Spock. Okay, just so we're clear on that, it's very important to know that. So good investor behavior is pretty difficult. 90% of investors do not earn the benchmark, let alone beat the benchmark. Volatility is probably the worst enemy of investors. So trying to eliminate volatility in a portfolio will actually create better behavior. Diversification is both safe and effective for that reason. And picking quality assets always takes a considerable amount of time. But these are sort of fundamentals to control the negative impacts of investor behavior.